Hello, my dear children. We all know that life is full of uncertainties causing loss or damage to lives and property. These uncertainties of lives include fire, theft, robbery, flood, death, and disability of human life, perils of sea for shipment of goods, and many others. Clear? If any one of these takes place, the individuals and or enterprise may suffer a huge loss. The loss caused by an uncertain event can't be eliminated, that we know, but it can definitely be minimized. So, the medium through which loss arising due to uncertainty of life can be minimized is known as insurance. So, insurance is a type of business services which removes the hindrance of risk associated with life or with property. Now, coming to the definition of insurance. Insurance is a device by which the loss likely to be caused by an uncertain event is spread over a number of persons who are exposed to it and who prepares to insure themselves against such an event. It means that it is a device, means it is a services that are being provided to the people in which the loss caused by uncertain event, means we are not knowing in advance that what type of uncertainty or mishappening will happen to us, and it is spread over a large number of people. Uncertainty or mishappening can happen to anyone in this world. So this loss that is going to be occurred due to uncertainties is being spread to all other people who have insured themselves against such mishappening which will cause the loss in their life. Clear? Now, insurance can also be defined as a contract or agreement under which one party agrees in return for a consideration to pay an agreed amount of money to another party to make a loss, damage, or injury to something of value in which the insured has a pecuniary interest as a result of some uncertain event. It's written. Now, means it is a contract between two parties, insurer and the insured one, in which the party who is insuring the people or the organization, they are ready to pay a lump sum amount of money, a sum assured, to another party who is going to insure themselves or who is going to insure their properties. Clear? Against what? Means how you are going to get the lump sum amount after the mishappening. For that you have to pay something to them in smaller amount as compared to the sum assured. Sum assured are the values of the life or the lives or the property which are being insured, and we insure only those things in which we have some financial interest or which has got some monetary value for us. The agreement or the contract that is being signed by both the parties are known as insurance policy. Now let's see the fundamental principle of insurance. The basic principle of insurance is that an individual or a business concern, means anybody can insure themselves or their property, means they choose to spend a definitely known sum in place of a possible huge amount involved in an indefinite future loss. Means the future, the whatever loss is going to happen to them, the mishappening, they don't know what is going to be the exact amount of the loss, but to cover those loss they are ready to pay a definite known sum. Means they are ready, they agree to pay a calculated sum of money to the insurance company. The known sum or the definite amount that they are ready to pay is known as the premium. So premium is the small periodic payment given to the insurance company to cover the risk of the large possible loss that may happen in the future. Insurance is a form of risk management primarily used to safeguard against the risk of the potential financial loss. Potential means which may happen in future. There is a possibility of happening such loss. It is defined as an equitable transfer of the risk of a potential loss from one entity to another in exchange for a reasonable fees. Means transferring of risk from, and risk of what? Risk of a potential loss, risk of a probable loss from one firm to another. Means insurance company are ready to share your loss, but in exchange for a reasonable fee, that is the premium. Then only they pay you they cover the risk of yours. Now the person whose risk is insured is called insured. Is the people or the organization who is taking the insurance for their life or for their property are known as insured, and the firm which insures the risk of loss is known as insurer or assurance underwriters. These are the basically insurance company who insured the people or enterprise or anything. Now coming to the insurance company is an association, a corporation or an organization who are engaged in the business of paying all legitimate claims that may arise in exchange of premium. So insurance company, already I have told you, are the insurer. Clear? They are there to pay you the money to cover your loss against the premium paid by the insured. Now the next topic is functions of insurance. There you can see logo of one organization, that is IRDAI. It stands for Insurance Regulatory and Development Authority of India. It's a statutory body formed to safeguard the interest of the various policy holders and to develop the insurance sector of India. Now coming once again back to the function of insurance. The first function is the providing certainty. Insurance provides certainty of payment for the risk of loss. There are uncertainties of happening of time and amount of loss. Insurance removes these uncertainties and the assured receives payment of loss. The insurer charges premium for providing the certainty. I think these content already we have discussed that when we get ourselves insured or when we insure our property, there is a certainty that if there is any mishappening or if there is any loss that may happen in the future, against that we will receive the payment related to the value of the product or value of the life that has been lost. Clear? The second one is protection. To provide protection from probable chances of loss is one of the function of insurance. We all know that insurance cannot stop the happening of a risk or event, but they can compensate for the losses arising out of it. So we get protection for our loss that may occur in future. The third function is risk sharing. Already we have discussed this function of insurance while discussing or while explaining the definition of the insurance. So on the happening of a risk event, the loss is shared by all the persons exposed to it. The share is obtained from every insured member by ways of premiums. Means now here comes the point that if we are paying the premium when we get the insurance, in return of that we get the sum assured amount, which may be huge in amount, from where insurance companies are having or bringing the money to pay us the insured amount. Basically, insured amount is the accumulation of all those premiums paid by various other insurance policy holders. So we can say that risk is being shared or the risk amount is shared by so many other people. Clear? Now, the last function of insurance is assist in capital formation. The accumulated funds of the insurer received by the way of premium payments made by the insured are invested in various income generating schemes. It means that the premium that the insurer are receiving from the various policy holders, what they are doing, they are investing it into the various projects, various industries to get the maximum return. So it helps to boost up the economy also as well as the capital formation. Hope all these four functions are clear to you all. Now we will move on to the principles of insurance. There are 7 principles of insurance. The first one is principle of utmost good faith. Then comes principle of insurable interest, principle of indemnity, principle of contribution, principle of subrogation, principle of mitigation, and finally the principle of causa proxima or the principle of proximate cause. We will discuss all these 7 principles one by one. Let's start with the principle of utmost good faith. Let's see. Insurance is a contract of uber mai fide, that is a contract founded on the utmost good faith. Here, both the insurer and the insured, means the person who is taking the insurance and the company who is insuring, should display good faith towards each other. And it is the duty of the insured to voluntarily make full and accurate disclosure of all the facts, all the risk associated with the thing, whether life or the property which they are going to insure. As well as same thing applies to the insurer also. They should also make clear all the rules, regulation and facts related to the insurance policy. They should not, means both the parties should not hide any fact related to the insurance policy from each other. If the insured conceals or fails to disclose any material fact, the contract of insurance becomes voidable, that is null and void, or can be cancelled at the discretion of the insurer. Just an example, Ram is a heart patient, but he concealed this fact, he hid this fact to the insurance company while taking his life policy. On his death due to heart attack, the insurer came to know about the cause of his death and they refused to pay anything to his legal representative or to his legal hire because a material fact was hidden by the insured. Means the insurer cancelled the insurance contract. The next principle is insurable interest. The insured must have an insurable interest in the subject matter of insurance. Insurable interest means some pecuniary interest, means interest related to financial matter. The insured must have an interest in the preservation of the thing or life insured so that he or she will suffer financially on the happening of the event against which he or she is insured. It means that insurable interest differs with every contract of insurance, be it house, factory, or life of spouse or children. The insured must have an interest in the preservation of things or life insured, and he or she will suffer financially on the happening of the event against which he or she is insured. Without insurable interest, the contract of insurance is void. And in case of life insurance, means when we are insuring the life, the insurable interest of the insurer must be present when the contract is brought into effect, but not necessarily at the time when the claim is made. After insurable interest, the next principle of insurance is indemnity. All insurance contracts are contracts of indemnity. Here it means the insurer, means the insurance company, undertakes to put the insured means the person or the institution who have taken the insurance policy, in the event of loss in the same position that he or she or they occupied immediately before the happening of the event insured against. The insurer undertakes to compensate the insured for the loss caused due to damage or destruction of the property insured. The compensation payable and the loss suffered are to be measured in terms of money, means compensation has to be given in terms of money. So we can say that indemnity means a promise to compensate in case of loss. The objective of any insurance contract is to place the insured as nearly as possible in the same financial position as he was before the occurrence of the loss. Means before the mishappening, what was its financial position? The insurer tried to put the insured in the same position by paying them the money, so that whatever loss has been occurred, it will compensate the loss. The next principle is proximate cause or causa proxima. This principle suggests that an insurance policy is designed to provide compensation only for such losses as are caused by the perils which are stated in the policy. Means only such mishappening will be covered whose causes or whose cause are insured or stated in the policy. When the loss is the result of two or more causes, the proximate cause means the direct cause by which the loss has been occurred, or the most dominant and the most effective cause will be considered. In case of loss arising out of any mishap, the most proximate cause of the mishap should be taken into consideration. Clear? It means, or we can say that this principle states that the insured is compensated or will be compensated only for the loss caused by the reasons mentioned in the insurance policy. But if losses are incurred due to reasons not stated in the insurance policy, then this principle is, when a certain principle is followed. What is the principle? When the loss is the result of two or more causes, the proximate or the nearest one should be taken into account to determine the liability of the insurer. Clear? And if the nearest or the proximate cause is insured, the insurer is bound to pay compensation, otherwise not. The next one is subrogation. As you can see that the subrogation is the principle which refers to the right of the insurer to stand in the place of the insured after settlement of a claim, as far as the right of the insured in respect of recovery of an alternative source is involved. After the insured is compensated for the loss or damage to the property insured, the right of ownership of such property passes on to the insurer. And as the insured should not be allowed to make any profit by selling the damaged property, or in the case of lost property being recovered, so we can say that the right of the ownership of the property for which the compensation has been paid passed on to the insurer, so that under no circumstances the insured is allowed to make any profit by selling the damaged property, or if they have been compensated against some lost property, so if that property is being recovered, so they cannot resell it to make profit once again. Or we can say that the insured, they don't have any rights over the destroyed property or the recovered property once they have received the compensation for that. The next principle is contribution. You can see the definition. It is the right of an insurer who has paid claim under an insurance to call upon other liable insurer to contribute for the loss of payment. It implies that in case of double insurance, the insurers are to share the losses in proportion to the amount assured by each of them. In case of a loss, when there is more than one policy on the same property, the insured will have no right to recover more than the full amount of his actual loss. And if the full amount is recovered from one insurer, the right to obtain further payment from the other insurer will cease. Or we can say that when the same risk is insured with two or more insurer, then it is known as double insurance. Or we can say that if a person has taken more than one insurance policy for the same subject matter, then all the insurer will contribute the amount of loss in proportion to the amount assured by each of them, and he will be compensated only for the actual amount of loss. Separately, the insured cannot claim total loss from each insurer because he has no right to recover any extra amount over and above the amount of the actual loss. If the entire amount of loss has been paid by one insurer, he is entitled to receive nothing. Means if the entire amount of loss has been paid by one insurer, then other insurer will not pay him anything. And finally, the last principle is mitigation. It is the duty of the insured to take reasonable steps to minimize the loss or damage to the insured property. Suppose goods are kept in a storehouse, catches fire, then the owner of the goods should try to recover the goods and save them from the fire to minimize the loss or damage. The insured must behave with great prudence and not be careless just because there is an insurance cover and that they are going to compensated for that. If reasonable care is not taken like any prudent person, then the claim from the insurance company may be lost. So we can say that it is the duty of the insured that he must take reasonable steps to minimize the loss or the damage to the insured property. And if it has been found that they have not taken proper care to save the property, because if the property has been insured, it means he has got some insurable interest in it. And if a person is having insurable interest in any of the life or in any of the property, no doubt he will go to any extent to save the life or save the property. So if it is found that the insured didn't take any step to minimize the loss or to save the property, the insurer can cancel the claim filed by the insured. We have covered all the principles of insurance, and in this lecture video we have seen what is insurance, what is its meaning, concepts, what are its functions, and what are its principles. The basic principles of insurance is different from basic, or the fundamental principle of insurance is different from these 7 principles of interest. Principles of insurance, sorry. One thing you might have noticed that all these principles have been formulated in the favor of insurer rather than the insured. So go through the video properly, attentively, make the suitable notes and try to learn the things properly. In the next lecture video, we will see the types of insurance, that is life, marine, fire and health insurance. Thank you.